Welcome back, everyone. Today we're going to take a look at the top 20 dividend growth stocks. We're going to talk about who these companies are, how they found their way onto this list, and I'll tell you about the new enhancement I am testing in this strategy to hopefully make it even better. The strategy is, of course, my 4-factor dividend growth strategy that many of you that have followed the channel for a while will be familiar with. If you're new here, the 4-factor strategy is my alternative SCHD strategy. Essentially, I took what I liked about SCHD and its underlying stock selection process, and with a few minor enhancements, I turned it into my own custom-tailored version of SCHD that aligns with my investment philosophy. My investment philosophy is quite simple. I believe that investing in high-quality dividend growth stocks, buying them when they are attractively valued and present a strong potential return, is the best long-term investing strategy that maximizes my odds of success. So let me tell you how this strategy works. The 20 best stocks it's selected for August. I'll show you the results my personal portfolio has achieved thus far, and we'll wrap up with the new enhancement that could possibly make this strategy even better. The strategy is very simple. It starts by finding a universe of potentially high-quality companies. I use a stock screener to do this. Then I rank all of these companies to find the most opportune ones, and this is done by borrowing SCHD's stock selection process with some minor modifications. Once these two steps are done, I invest in the top 20 stocks and hold these positions for exactly 1 year and simply repeat the process. Let's unpack each part a little bit. Step 1 is finding high-quality dividend growth companies. For this, I use Schwab's stock screener and 8 different criteria. One of the criteria is focused on availability, 4 are focused on quality, and the final 3 are geared towards dividends. The first criteria is that the stock must trade on the New York Stock Exchange or the Nasdaq, because as a US-based investor, I want to easily be able to invest in the stocks I find. The 4 quality criteria are an economic moat, a strong management team, and growth. I screen for companies that have a wide or narrow moat rating from Morningstar. These are companies that have an economic moat around their core business that gives them a competitive advantage. I also screen for an exemplary or standard stewardship rating from Morningstar. This identifies companies with better than average leadership teams. The growth criteria focus on a 5-year revenue and earnings per share growth rate of at least 5%. Why? Because a growing business is a better business. And without top and bottom line growth, it's very difficult for a company to generate returns for its shareholders. The final 3 criteria all focus on dividends, and they are the 3 and 5-year dividend growth rate and the payout ratio. I screen for a 3 and 5-year dividend growth rate of at least 5% and a payout ratio of 80% or less. This helps me identify companies that have a decent track record of increasing their dividend payouts, but also ones that still have room to continue doing so in the future. The point of this stock screener is to create a quality funnel, to take the 5,000 plus US-based stocks and narrow in on the companies that stand out amongst their peers. In my opinion, companies that meet all of these conditions have a high probability of being higher quality businesses relative to companies that fail to meet these criteria. When I run this screener every month, I typically get a list of 100 to 120 unique companies. I then take this list and move on to step 2, the ranking process. For this, I use Seeking Alpha to export 4 data points for each of these companies. Those data points are the free cash flow to total debt ratio, the forward dividend yield, the 5-year dividend growth rate, and the return on capital. I use these 4 data points to rank all of the companies. The goal of the ranking process is to find the companies that have the best combination of these 4 metrics. Let me explain this by using the August list as an example. The top 20 stocks selected for August have a free cash flow to total debt ratio of 433%, while the 122 stocks that the stock screeners spit out have a ratio of 161%. That's roughly a 2.7 times better liquidity for the chosen stocks versus the entire quality universe. The 20 chosen stocks have an average 5-year dividend growth rate of 24.46%, compared to an average of 13.75% for the universe. The chosen 20 stocks have an average return on capital of 24.43%, compared to 15.49% for the universe. And the chosen stocks have an average forward yield of 2.01%, compared to 1.71% for the universe. Individually, not all of the chosen stocks stand out amongst the universe in each of these 4 metrics. but collectively, they appear to be more favorable. And the focus here is on the collective appeal of the ranking process. Alright, so let's take a look at the 20 chosen stocks. Number 1 is Novo Nordisk. It pays a forward yield of 4.57%, has a 21.92% 5-year dividend growth rate, a 47.91% return on capital, and 110.55% free cash flow total debt ratio. Number 2 is Progressive, with a forward yield of 2.03%, a 65% 5-year dividend growth rate, a 24% return on capital, and a 232% free cash flow to total debt ratio. Number 3 is EOG Resources, with a 3.37% forward yield, a 23% 5-year dividend growth rate, a 14% return on capital, and a 227% free cash flow to total debt ratio. Number 4 is Wipro, with a 4.23% forward yield, an 89% 5-year dividend growth rate, a 9.5% return on capital, and 107% free cash flow to total debt ratio. Number 5 is ASML Holdings, with a 1.02% forward yield, a 22% 5-year dividend growth rate, a 34% return on capital, and a 302% free cash flow to total debt ratio. Number 6 is Fastnell, with a 1.9% forward yield, an 11% 5-year dividend growth rate, a 23% return on capital, and a 205% free cash flow total debt ratio. Number 7 is Old Dominion, with a 0.76% forward yield, a 32% 5-year dividend growth rate, a 20% return on capital, and a 924% free cash flow to total debt ratio. Number 8 is Accenture, with a 2.16% forward yield, a 13% 5-year dividend growth rate, an 18% return on capital, and 134% free cash flow to total debt ratio. Number 9 is Diamondback Energy, with a 3.6% forward yield, a 27% 5-year dividend growth rate, an 8% return on capital, and a 53% free cash flow to total debt ratio. Number 10 is Monolithic Power Systems, with a 0.85% forward yield, a 25% 5-year dividend growth rate, a 14% return on capital, and a 4,488% free cash flow to total debt ratio. Number 11 is Nvidia, with a 0.02% yield, a 14% 5-year dividend growth rate, a 69% return on capital, and a 740% free cash flow to total debt ratio. Number 12 is ADP, with a 1.98% yield, an 11% 5-year dividend growth rate, a 28% return on capital, and a 54% free cash flow to total debt ratio. Number 13 is Lam Research, with a 0.93% yield, a 14% 5-year dividend growth rate, a 24% return on capital, and a 99% free cash flow to total debt ratio. Number 14 is Watsco, with a 2.71% yield, an 11% 5-year dividend growth rate, a 12% return on capital, and a 96% free cash flow to total debt ratio. Number 15 is Dick's Sporting Goods, with a 2.28% yield, a 31% 5-year dividend growth rate, a 12% return on capital, and a 27% free cash flow total debt ratio. Number 16 is Ameriprise, with a 1.23% yield, an 8% 5-year dividend growth rate, a 43% return on capital, and a 208% free cash flow total debt ratio. Number 17 is Rollins, with a 1.15% yield, an 18% 5-year dividend growth rate, an 18% return on capital, and a 67% free cash flow total debt ratio. Number 18 is Applied Materials, with a 0.97% yield, a 14% 5-year dividend growth rate, a 20% return on capital, and 111% free cash flow to total debt ratio. Number 19 is Infosys, with a 3.03% yield, a 5% 5-year dividend growth rate, a 22% return on capital, and a 423% free cash flow total debt ratio. And number 20 is Zoetis, with a 1.34% yield, a 20% 5-year dividend growth rate, an 18% return on capital, and a 43% free cash flow total debt ratio. I have 2 brokerage accounts that I've allocated to this strategy. The first account has a market value of roughly $2,700, and this is the original 4-factor portfolio started on November 1st, 2022. The second account has roughly $220,000 in capital, and it was transitioned to the 4-factor strategy during 2023 and 2024. I'll focus on the first portfolio here, since it has a longer track record and it is also a much cleaner portfolio to review. There were no cash flows in or out of this account since this strategy was launched, so all the growth is organic and it makes tracking the results very clean. This strategy was launched with $1,812.75 back in November of 2022, giving me a 33-month history. The portfolio has a 14.66% compounded annual growth rate thus far, which in my opinion is very nice and above my long-term target of 12% CAGR. During the same time period, SCHD's CAGR stands at 6.69%, so my portfolio has provided twice as much growth. The portfolio currently yields about 2.2%, and it has a 25.41% dividend growth rate based on projected annual dividend income. If we annualize this over the 33-month history, that equates to an 8.58% annual dividend CAGR, a little bit slower than I'd like. Measuring dividend growth based on actual dividends paid, the growth rate from year 1 to year 2 was 32.24%. Year 3 is still ongoing, but if we look at the dividend growth rate for the first 9 months for years 2 and 3, we can see that the dividends are coming in 10.26% higher in year number 3. This will likely change over the next 3 months, but I don't think we can expect it to move much higher or lower. While this strategy has outperformed SCHD in terms of total return, it lags the ETF in the dividend income department. In year 1, SCHD generated 36.11% more dividend income. In year 2, that gap shrunk to 27.29%, and in year 3, it has shrunk again to 23.55%. Since my portfolio is generating a higher total return and seeing higher dividend growth than SCHD, it's natural to expect the dividend income gap to shrink. If this pattern continues for a few more years, I expect that this portfolio will not only generate more capital than SCHD, but it will also produce a larger dividend income stream. Another way to measure this gap is to look at the yield on cost for the portfolio compared to the yield on cost for an equivalent investment into SCHD. At the end of year 1, after the portfolio paid 12 months of dividend income, the yield on cost was 2.28%. The simulated yield on cost for an equivalent investment into SCHD at the same point in time was 3.57%. That's a roughly 1.3% gap. Following July 2025, the portfolio's yield on cost has moved up to 3.16%, a 38.53% increase, while SCHD's yield on cost has moved up to 4.45%, a 24.71% increase. You'll notice that the gap between the two yields on cost remained unchanged at roughly 1.3%, which may give the illusion that the gap is not shrinking. But the more important number here is the pace of growth and not the actual gap. So if we were to extrapolate the 38 and 24% growth rates into the future, we can see that the point of intersection for these two yields on cost should happen 31 months from today. So roughly, in 3 years, this portfolio can catch up to SCHD in terms of annual dividend income, provided of course the current trends continue to prevail during this time. It'll be interesting to see how this unfolds. Alright, last but not least, let's talk about the new enhancement to this strategy that I am testing. To quickly recap, the strategy currently works on the following 2 principles. First, to identify potentially high-quality companies through the use of a stock screener, and then to rank them using the 4 financial metrics to narrow in on the best of the best. The one aspect that is currently not part of this process, but something I use in the majority of my other research, is a valuation or future potential return component. So I wanted to see if incorporating that into the 4-factor strategy would make any sense. The best way to do this is to run a parallel test right along with the regular 4-factor strategy. Let me explain how this works. First, I have to compute a valuation for each of the stocks, and since the stocks that come out of the stock screener change from month to month, I need a method that can be applied easily and quickly. So I decided to value these stocks by comparing their trailing 12-month price to free cash flow ratio to the 5-year average. Then I wanted to calculate the future return potential for each stock. And for this, I borrowed the formula I use in the Quality Investable universe in my newsletter. The return estimate is the sum of the forward dividend yield, a return to fair value component based on the price to free cash flow valuation, and the estimated earnings growth rate taken from Finviz. And the idea behind incorporating this value into the 4-factor strategy is to go down the list of the highest ranked stocks and select the top 20 stocks that also meet a minimum return threshold, In my case, that threshold is 12%. For August, out of the 20 chosen stocks I went over a moment ago, only 11 have a return estimate above my desired 12%. They are Novo Nordisk at 27.6%, EOG Resources at 12.8%, ASML Holdings at 28.7%, Accenture at 14.7%, Diamondback Energy at 21.2%, Monolithic Power Systems at 24%, Nvidia at 34.4%, ADP at 12.1%, Rollins at 13.3%, Infosys at 13.4%, and Zoetis at 17.1%. The other 9 chosen stocks were not even close to being selected, aside from Ameriprise that had a return estimate of 11.2%. So I continued going down the list, checking the return estimate for each stock, until I had my 20 chosen stocks. I had to go all the way down to stock number 42. Here are the 9 additional stocks that will be part of this test. MSCI with a return estimate of 18.9%, Graco at 17.2%, Visa at 13.4%, Domino's Pizza at 12.7%, Merck at 23.6%, MasterCard at 17.9%, Qualcomm at 14.1%, SEI Investments at 12.4%, and Amphenol at 19.2%. The plan is to run this test for 12 months and see what the results look like. I can also measure the return estimates against actual returns to see how effective these estimates are. If any of you are interested in following along with this journey, I share this entire file and publish the list of chosen stocks at the end of each month with my Patreon and Substack community. Links to both can be found in the description below. Thank you for watching and see you next time.